Hi friends, Lee Brickey here, your best source for real estate in Palm Beach County and the Treasure Coast. Now more than ever, I'm getting the question about the real estate market from clients and the comments you folks send in. And the question seems to always be the same. Is it a good time to buy? Where do you see rates going? Is the housing market heading for a crash? And why are all the real estate experts saying that we are low on inventory when we are seeing more inventory month over month? So today I'm breaking down the powerful insights of Barry Habib.
How you can do a real calculation. Instead of pulling a number out of your rear end, where do you think mortgage rates will go? Well, if we hit the target on the 10-year at 3.8 and the spread drops to 2.25, we do the math. 3.8, 2.25, that's low sixes for mortgage rates. That's about the target.
Barry goes over mortgage rates, tariffs, and why the housing market is far from crashing.
Hey man, so tell me, am I making the right decision here? Tell me, is this the right time to buy? I know rates just went up. I'm hearing about the recession, the stock market's going crazy, and people talk about home prices dropping. Inventory's up 30% year over year, and I just saw the Realtor.com just put out an article, and they said if there's a recession, home prices drop dramatically. I mean, am I making the right? Is this going to be okay doing this? I hear Diana Oleg on CNBC. Boy, she's a real pleasure. But is this the right time for me to be doing this? And can you tell me, like, where are rates going? Where are mortgage rates going?
So if you're a homeowner, buyer, seller, investor, or in the real estate industry, you're going to want to hear what Barry's predictions are for the real estate market in 2025 and what we could see going into 2026. So you can make good decisions from strong data, not a knee-jerk reaction or feelings like you're hearing all over the internet. So first, you may ask, who is Barry Habib? A couple of weeks ago, I went out to United Wholesale Mortgage, the largest mortgage company in the United States, with my mortgage broker and good friend Brent Starts. You've seen him on this channel many times if you watch. And it was a great trip. Not only was it one of the best run companies that I've ever seen, but it also has grown thanks to the CEO and the amazing team around him, from 15 employees to 9,000, now making them the largest wholesale mortgage company in the United States. It's in Detroit, Michigan. Brent and I went out there for a 2-day event, and they invited the top people in the real estate industry to speak. And one of those speakers was Barry Habib. To tell you who Barry is, he's one of the most respected minds in our industry. Barry has been honored with the prestigious Crystal Ball Award not once, but 4 times. So let's get into it. Last year, while most experts were calling for a housing crash, Barry forecasted a 4.5% appreciation, and he nailed it.
So let's start with that. So last year, I pulled a slide from last year. Here's our slide from last year. Let's do a 2024 recap. Let's see how I did. Real estate-wise, what did we say? We said that home price appreciation would be 4.5%. I remember a lot of you even asked me about that because we were coming off of 8% mortgage rates, worst home price affordability, everybody crapping all over the real estate market, people talking about 25, Patrick Bet-David, who's a dear friend of mine, saying 25% drop in home prices. So many people saying home prices are going to decline. We said 4.5% to 5%. We were kind of alone on an island out there. And guess where we came in at? By every single metric that you want to use, Cotality's here too, they're a sponsor, it all came in exactly on target. And what it did was it earned me the 4th crystal ball in 7 years. Now look, I'm not saying that so I'm breaking my arm trying to pat myself on the back. The reason I'm bringing this up to you is that that's 4 number ones, 4 out of 150 of the top account. Look, you've got JP Morgan, you've got Wells Fargo, you've got Goldman Sachs, and then you got little old me here, okay? And we beat all of those guys. The reason why I bring this up to you, and by the way, the other 3 finished in the top 10, is because the methodology that I'm about to share with you works. So by the way, let's start. We gave interest rate forecasts too. We missed that one a little bit. So we said to you last year, there's the slide from last year, we said, hey, the forecast, we think the 10-year Treasury 4.4, it topped out at 4.7. Said mortgage rates, we think they top out roughly 6 7/8. It topped out at 7 1/8. So we missed it on rates by about 0.25%. Now look, it's not an excuse, but I will tell you something that definitely didn't help me was that when the BLS, they're so freaking reliable, they came out and they told us during 2024 we had 2.5 million job creations. We find out it was like 1.2 million. So less than half the jobs that they told us were there were actually there. And you know how bad we get beat up every time a jobs report comes out and it's above expectations and rates go up.
So first, Barry talked about understanding the tariffs and inflation out there, clearing up huge misconceptions on tariffs.
But let's take a look at what we can expect this year. So let's take a look at what you can expect the rest of this year, and let's go category by category. So the first one is important. I'm going to talk to you about inflation first. And the reason that inflation is getting the first slide here on this is because Jerome Powell has come out and told us essentially that he is favoring inflation more than he's favoring labor. Now, just so you know this, the Fed has two mandates. They're both really important. They want stable prices, that means inflation, and they want full employment, which means low unemployment rates. That's the Fed's mandate. That's their job. Now, many times they're equal. Sometimes the labor part is a little bit more important. But what Jerome Powell has told us as recently as this morning in a talk is that inflation right now is something that they are more focused on, and they believe that the labor market is okay. Now, I disagree that labor is okay, and I'll explain why. But let's first talk about inflation and how interest rates work. Now, this is a trueflation chart of inflation. Trueflation measures inflation differently. There's a lot of inflation metrics. You got CPI, PPI, PCE, and there's a core rate. There's the headline rate. Let's call inflation right now in the U.S. somewhere around 2.5% as we look at all these different ones, okay? Just for round numbers. The BLS, which has just been awful, by the way, almost a joke. Did you see the numbers that came out this morning? You might have been in session this morning. So they had like revisions from last month's number that were like enormous. Like, how do you screw it up that bad? They've been doing it on the job numbers. Now they're doing it on the inflation numbers. I mean, who is working there? What have we got going on there? But in either case, the numbers that we are getting from them are very unreliable at best. And in addition to that, there's an enormous lag. By the time we get the data to the time it's published is a big lag. But inherently, and I've gone over this in the past with you, things like shelter, which are the largest components in these. It makes up 44% of core CPI, makes up almost 20% of core PCE. The shelter component has a 9-month to a 1-year lag. So we know that this data isn't really timely. And they look at 80,000 data points. Well, Trueflation looks at 10 million data points, and it's much more instantaneous. The difference between the two is instead of 2.5%, Trueflation says inflation's 1.5%. Now, given the reliability of the BLS and the lags, I believe Trueflation. So what does this clue us in on? Would you agree that inflation has a bearing on long-term rates? Yes or no? Okay. Would you also think that if this is a more accurate read on inflation and the lags from the BLS will eventually gravitate towards this, what does this tell you? This tells you that if everything else would remain the same, in Latin they call that ceteris paribus. If everything else remains the same, that the rate of inflation that we should be seeing over the next year should gravitate towards 2.5%. Now, this isn't going to stay the same. It could go down, it could stay the same, it could go up, it could change. But one thing we have in our back pocket, this is a good thing for us, is that the gravitational pull of inflation appears to be lower, which means that interest rates long-term should be on a trajectory of improvement and lower. It might take some time to get there all the way down to these levels, and things can change, as you've witnessed with the tariff stuff, which threw us into a tizzy. We were doing beautiful. We got down to under 4% on the 10-year, and then all the tariff stuff happened, and it was all bets off. But you could see there seemed to be a trajectory that we were on that was a very good trajectory. Obviously, things can change. But this tells us that at least the future looks bright from an inflation standpoint. Now, we talked about tariffs a minute ago. Tariffs are so misunderstood. I mean, all you hear about tariffs is, but who really understands them? I mean, think about it. Very few people. Do you really understand how the tariffs work? Because if you talk to somebody, you say, okay, well, there's tariff against Vietnam. Vietnam's paying it? No, Vietnam doesn't pay it. The tariff is paid by the importer who's here in the United States. Vietnam doesn't pay anything. China doesn't pay anything. When that good comes to us, the importer pays it. Now, let's say a 10% tariff. Does that mean the item went up in price 10%? Do you think that you're paying 10% more for it? Yes or no? That's a smart guess. You're not. But let's work on the math. because nobody does this or breaks it down. By the way, the dollar strength also has a big variable. If the dollar gets stronger, you mitigate the tariff because the dollar buys more. If the dollar weakens, well, then it actually makes the tariff worse because the dollar buys less. Like if you go to Europe and it costs more, you go to Mexico, you buy more with the same dollar. You know what I'm saying? Okay? So let's take a look at this. Let's say there's a shirt that you get from Vietnam. So the shirt's $10 is what the importer pays for it normally. But now there's a tariff. So it's just like a tax. It's just like when you go to a store and you get, okay, here's the price plus a sales tax. There's a new sales tax on that imported item. Tariff. The importer pays that tariff of 10% or $1. Now, that's not what it gets sold for. What it gets sold for, it happens after that. The importer, they're going to mark it up to the wholesaler. Wholesaler's going to mark it up to the retailer. And the retailer is going to take that overall price and they're going to mark it up to the customer and they'll probably put it up there for like $29.95. And that's the price of the shirt. Now, how about if there wasn't a tariff? If there wasn't a tariff, well, it'd be $28.95. So it sounds like a 10% tariff, but it's different than that. Now, China is a different story. We had 145% tariff on China. That was all window dressing. That was nonsense. Once you get to 50%, it does not make sense to do business with you anymore. And ships stopped coming over. So 2 Fridays ago, when the U.S. had 0 ships leaving China for the U.S., Scott Bessent went to go make a deal. And the result of it is that if we can get a deal with China, who knows what the end result would be on the rate of tariff, whether it stays at 30, where it goes down to 10, whatever it is, it's better than not having items on the shelf.
Also, Barry went over GDP and the Fed's blind spots. He calls out Jerome Powell's Fed for cherry picking data. When GDP prints negative, they blame imports. But when we see 1.3 million phantom jobs added, suddenly to the data is solid gold. How is that possible?
We see the unemployment rate going up to about 4.5% from its current 4.2. That's going to get the Fed's attention because if you look at what the Fed is projected, very few Fed members think it goes above 4.5%. So that means the Fed's going to start to rethink things and we're going to start to see lower rates.
Next, Barry talked about what the Fed gets wrong about rates. Here's how Barry knows the Fed's being too restrictive.
Now, speaking of the Fed, and I've got issues with the Fed, let's talk about them. So one, they got a GDP report for the first quarter. And the GDP report reported -0.3 for the first time in 3 years. Now, there are reasons why it reported negative. And here's where I will give the Fed credit. The Fed finally used their ability to think critically. Remember, Jerome Powell is no economist. You know what Jerome Powell is? Who knows? He's a lawyer. He's a lawyer. I would not want to have an economist going up to try and get me off of a murder case, okay? I'd rather have an attorney, and I think we should have an economist at the Fed. But yet we have several members who are attorneys, but not trained economists. Because they say the job numbers are great. Yeah, we got 177,000 jobs instead of 130. But then they said, okay, well, let's forget about those revisions. We're getting negative revisions every month. I told you in 2024, there was 1.3 million jobs that never happened. And we paid the price for it. Take a look at the revisions just from last month was 60,000. Before that month was 50,000. Why are they not saying that? And then something called the birth-death ratio, which is absolutely ridiculous. They don't know how to handle small businesses. So they say, well, let's come up with this thing where we estimate the growth of how many small businesses opened, how many small businesses closed, and then guess how many employees at each of those businesses. It is pure guesswork. They have no freaking clue. How many jobs did it add? 393,000 jobs non-seasonally. We estimate on a seasonal adjusted basis, it put in 79,000 jobs. But nobody looks deep into the details. So the media sees, oh, great job number. Jerome Powell sees it. He doesn't know how this stuff works. The Fed funds rate is 4.375 right now. And the Fed is very restrictive. You've heard the term restrictive, yes? Okay, so there's restrictive, there's neutral, and there's accommodative. There is a calculation to get to a neutral rate. So what does restrictive mean? Slow the economy. Accommodative means they want to do what? Ramp up the economy. So if we know that there are these holes out there, and we know that by Jerome Powell's own words, that Fed actions have long and variable lags. In other words, if the Fed cut a quarter point today, it takes months, 6 months, maybe more, for it to make an effect on the economy. Why in the world are they so restrictive at these levels? They're intentionally trying to slow the economy.
The Fed's fund rate is sitting around 1% too high. If they just cut it by that amount, we'd be back to a neutral market, and mortgage rates would then start to ease up also. Then he talked to Scott Bessent, our Treasury Secretary, and his plan to help the housing market. Barry says that the Treasury Secretary Scott Bessent told him he wants a 3.9% 10-year Treasury note. That drives up the bond demand and pushes yields down and is a direct path to lower mortgage rates.
Now, the Fed's cut rates. They cut rates 100 basis points last year. So why did mortgage rates come down? And if the Fed starts cutting now, will mortgage rates not come down? Let me explain to you what happened and why it's different here. Because the Fed funds rate, it's going to be very comparable to what you can get in yields for things like money market rates. So a money market rate that's out there is going to be kind of close to the Fed funds rate, maybe slightly below, maybe slightly above. Money market rates today are like between 4.1, 4.3% today. So what's the impetus to take my money out of a money market that's safe and put it in a 10-year Treasury? Now, obviously, 10-year Treasury is closer to 443 today, so it's a little, it's a moving target here. So it's a little higher than it's, but there's not that much of a difference for me to get another 0.25% to move my money out of a money market and put it in a 10-year Treasury. Why would I do that? And in the past, remember, the Fed funds rate was 1% higher, so money market rates were over 5%. So as the Fed was cutting, why should I take money out of a money market rate? Because money market's going to go down as the Fed cut rates. So as it went from 5.1 or 5.2 to 4.7 to 4.5 to 4.1 or 4.3 or wherever it is, why would I take my money out of a money market and put it in a 10-year Treasury? It's just no impetus. But if the Fed starts having the mindset of cutting rates, which is what they should be doing, if the unemployment rate gets to 4.5%, if inflation starts to come down and the Fed can't be as restrictive, that the economic conditions start worsening, they start cutting. And if they do cut by the amount we think they're going to cut by about 0.75%, well, then money markets are going to be 3.3. Now, what do I do? Do I leave my money in a 3.3% money market, or do I start buying treasuries and get 1% more, 0.75% more, 0.5% more? And that's when you start to see Fed cuts helping 10-year treasuries come down and helping mortgage rates come down. Even though people are expecting zero, maybe something at the end of the year, we think the economic conditions are going to worsen, and we're going to see that. All right, so how does that help us with mortgage rates? Number one, Scott Bessent, our Treasury Secretary. Now, I had a chance to talk with him and meet with him and have some very meaningful conversations with Mr. Bessent. I will tell you this, he is brilliant. He's on top of it. And I'm going to also tell you this, I am not in any way, shape, or form being political here, so please just like not even let that go astray here. What I care about is, how does this affect interest rates? How does it affect real estate? That's all I care about. I've never had a Treasury Secretary that I've seen say things like, hey, I want to unfreeze the housing market. I've never had a Treasury Secretary say, hey, I'm concerned with the mortgage spreads and I want to figure out how to reduce the mortgage spreads. You guys ever hear that before? Treasury Secretary saying, I'm going to use the issuance in treasuries to bring down the 10-year Treasury yield so mortgage rates drop. Now, back to Scott Bessent. This was something really important that you need to know. He is big on the bank deregulation deal. And he said, Barry, when we get the bank dereg deal, when we get that done, that's going to make it easier for banks to hold treasuries. Right now, banks are limited in the amount of treasuries that they could hold. If it's easier to use leverage for banks to hold treasuries, and the way it works is kind of funny. If you have borrowing power on being able to do that, you can make multiples of the return. You could take like a bond that's yielding 4% and you can wind up getting 15, 18% on it with leverage. So by using this bank dereg deal, banks will want to buy more treasuries. If they absorb some of the treasury supply and banks are holding it as an investment, that helps interest rates come down. Issuance. He said that what he intends to do to help bring long-term rates down is, now we've got a big deficit, right? I mean, you know this. Okay, we take in taxes and income somewhere around $4.5 trillion. We spend somewhere around $6.5 trillion. We've got a $2 trillion annual deficit. Just like a family that's living above their means, how do you make up the difference? You make up the difference by doing what? You borrow it, okay? So how do we borrow it? We issue what? What? What do we issue, everybody? Treasuries. That's how we make up the difference. We borrow it. So the bigger the deficit, the more paper we got to issue, the more we got to say, please take our paper. And if not everybody takes it, why do interest rates go up? Because we got a lot of paper to put out there. That's why. Now that paper comes in the way of 1 month bills, 3 month bills, 6 month bills, 1 year bills, 2 year notes, 3 year notes, 5 year, 7 year, 10-year notes, 20-year bonds, 30-year bonds. That's the array. We're most closely tied to 10-year Treasury notes. That's what mortgage rates are most closely tied to. So what Scott Bessent said is he will issue more short-term paper and less long-term paper. What does that mean? There's a need for people to buy long-term paper. You have to match it if you've got pension funds. If you're a mutual fund that says we invest in long-term, they have to buy that stuff. So if there's less of it to buy, what typically happens to the price, everybody, if there's less to buy? The price goes, you got it. And when bond prices go up, just like if you're watching, bond prices go up, what does that do for interest rates? Do you see how this is working here?
Barry also went over the demographics of millennials and Gen Zs and said they are pushing home ownership. We're expecting 18 million new buyers over the next 10 years.
So a look at the housing market, 136 million households, 91 million are owned, sitting on 37 trillion in equity, 407,000 per household. Rented, by the way, whoops, I didn't mean to do that, 45 million homes rented, they've got zero equity. Now demographics is destiny. Let's look at this one real quick. Here's your demographic groups: boomers, Gen Xers, millennials, Gen Zs. These are the ages, and this is the population of each one. The current home ownership rate is there. Now let's forecast out what's the real estate market going to be in 10 years. Because somebody's going to buy a home, typically they stay there 10 years. So you want to know where the real estate market's going to go in 10 years? Let's take a look. 10 years, boomers. Some boomers are going to get older. Some are going to be going to assisted living. Some won't be here. So therefore, their home ownership rate will decrease. But Gen Xers are on the rise still. Their homeownership rate's going to increase. So those two cohorts over the next 10 years will probably flip-flop. Gen Xers closer to 75%, boomers close to 65%. So between the two, not much change. They'll kind of cancel each other out. But now look at millennials. Millennials, 73 million of them, currently 45% homeownership rate. When they were 30, it was 33%. When they were 40, it's 55%. So as you can see, as they get older, the homeownership rate increases. Now, of those people, the 73 million of them, their homeownership rate of 45% with a median age of 35. But how about of those, if we said, okay, not all 73 million, let's reduce it to a median age of 30. So there's about 40 million with a median age of 30. Their homeownership rate is 33%. What's going to happen in the next 10 years to that cohort? They're going to go from 33% to what? 55% when they're 40. You see that number there, 55% when they're 40? So that means that on 40 million people, 22% of 40 million people, it's roughly 8.5 million more homeowners. But now how about the Gen Zers? Gen Zers median age is 20. They got an 8% home ownership rate. In the next 10 years, their median age is going to be 30. If they take a lead from the millennials, what's their home ownership rate going to be 10 years from now? What's it going to be? 33%. So that's an increase of 25% on 69 million people. That's roughly 17 million more homeowners. So you add the two together, you got 25, 26 million more homeowners. Some will buy as couples, some will buy as individuals, but it's generally accepted that it's 18 million more homeowners in 10 years. If we need 18 million more homeowners in 10 years, or we're going to get them, how many per year? How many households form per year? 18 million in 10 years and 1.8 million a year, right? Well, have we been doing that? Is this a weird number? Well, let's see. What have we been averaging the last 5 years? Would it surprise you that it's exactly 1.8 million average the last 5 years? Exactly. So we know these numbers are good. Now, how many homes are builders building per year? Because that's how much you need. Builders are putting up 1.3 million. You've got a shortage. But Barry, inventory levels are up. Yeah, inventory levels are up. That's true. Inventory, and by the way, I look at active listings. They're up 30% year over year, but from extraordinarily low levels. What if we look at a normal time instead of 1 year? If we look at pre-COVID, that's where we were. We're down 16% in inventory, and our population's gone up by 12 million people at least, okay? At least. So now we know that inventory is still tight.
So that's it. Let me hear your thoughts. Drop your comments in the comment section below. And if you like this video, do me a favor and like this video. I really appreciate it. Give me a thumbs up, and then also share this video with someone you think it could help. And don't forget, if you're looking to buy or sell real estate anywhere in Palm Beach County or the Treasure Coast, reach out to me, Brickey. My information is right there on the screen. I would love to help you. And if you have not yet subscribed, go ahead and tap that subscribe button, ring that notification bell so you don't miss any of our real estate tips and tours. And if you have not watched our latest video on what's happening with property tax relief here in Florida, you can watch that video right there. Be kind to each other, and I'll see you in the next video.